Hey everyone, it's Mike, and welcome back to the Orderflows Absorption course. This is Module 3, Recognizing Absorption. Now, before I begin, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right, absorption. Now, absorption is measured by analyzing passive trading activity. Most traders only look at aggressive trading activity, which is what moves the price up and down. But absorption can be seen in sideways activity. One of the drawbacks in analyzing passive activity is you don't know if it's profit taking or a new position. However, a trader in a position taking profits is more inclined to move his passive order to an aggressive order if the market starts ticking away from him. After a big move up, the first signs of aggressive selling is most likely due to profit taking than supply hitting the market. So when you see a move up and you start seeing the bids getting hit, usually what it is that's not supply coming into the market per se. Usually on the move up, when you see the big offers, that's the supply. But if you start seeing the bids getting hit, you start seeing the selling imbalances up near the high, what you're starting to see is possibly new orders, new positions rather, coming into the market. So let's take a look at sideways absorption. Okay, so sideways absorption is usually marked by heavy volume and price not making new highs necessarily or new lows, but mostly going sideways. So here we are. Again, it's the E-minis 5-minute chart. And you notice we have this big sideways activity here, okay? You have some volume in here. This bar here at the high, 13,000, 12,000 here. This big bar here, 18,000, 19,000. So you see these bars here starting, okay, after this big push up, you're looking at these bars here, 12,000, 12,000, 13,000, 12,000. Come in here, 17,000 again. You're in this area of sideways activity. You got some decent volume, right? You got some light volume, 7,000, 5,000, 8,000, but you got strong volume, 12,000, 12,000, 15,000. Market's not really going higher. Then you got the big heavy volume in here, 17,000, the big down red bar with a couple selling imbalances, stack selling imbalances in it. Volume is high. I mean, you had the big volume here, 18,000. That was your big push up. Now your big push down is on heavier volume than normal, but you're churning in here with above average volume. Normally your volume is going to be around 10,000, but here you're pushing 15, 12, 10, 13,000, 12,000. The market's not going anywhere. It's not going any higher, right? You're expecting this market to go higher. Now, obviously, one of the reasons why is you have, look at all this negative delta, negative delta, negative delta, negative delta, negative delta, negative delta. Every time it tries to poke higher, you have someone coming in there sort of putting their foot on that market, holding it down. Now, don't confuse consolidation with absorption, okay? Consolidation will happen on light volume, and it's going to happen usually in front of a data release or a speech or something, or big news that everyone's expecting to hit the market. And you can see here where it's going sideways. You look at this volume, 1,700, 1,400, 1,300. When normally you're pushing, several thousand, 2,000, 3,000, 1,900, 2,000, 2,005, 5,000, 5,000, 4,000, 7,000. Here you're just trading 1,700, 1,400, 1,300. Then obviously, it's 1 o'clock. Something happened here at 1 o'clock. You got the big volume expansion, 7,800. Another big volume expansion here, 15,000. This is congestion, or sorry, not congestion, consolidation. All these terms start sounding alike after a while. Consolidation is marked by light volume, and it's market that's quieting down because people aren't really interested in trading right now for whatever reason. Like I said, it could be a speech, there could be a data release, whatever. People are anticipating something to come out shortly that they're just waiting on the sidelines for it. And then obviously you see what happens. Boom. So understanding when a market is experiencing absorption is important because you're in a trade and market starts trading sideways. It can be either a sign of absorption or accumulation or distribution. Now, if it's absorption, the market has a good chance it will reverse. Now, not always. It can pause and go in the original direction, but for me, the way I treat absorption is I use it for reversals, right? I'm looking for a market to reverse. So if it's accumulation, generally, or distribution, the market is going to resume its move in the original direction. Now, distribution, I'm sorry, I shouldn't have put that in there. It's a little misleading. Generally, with distribution, what you're looking for, people don't necessarily think of distribution as market selling off, going sideways, then market selling off some more. Usually when people talk about distribution, it's at a high a day, market selling off. But generally accumulation and distribution, in general terms, people are looking for it to pause and then continue on in its original direction. Whereas for me, absorption, I'm really looking at it more as a reversal, but it doesn't necessarily have to be a reversal. So strong uptrends do not break easily, okay? As the market keeps moving up, it attracts additional buyers until the market reaches a point where it's trading too far above value, where traders start to notice how far away from value the market is currently trading, and where they can start selling. See what I talked about on the previous lesson about price exhaustion. So on this price action, traders late to the party start getting long, usually trend traders. Trend traders tend to be breakout traders, and push prices up where sellers are happy to sell more supply. Now, again, you always hear these fantastic returns of trend traders, but what you don't hear often is, trend traders are right maybe 20% of the time. Because why? Is because the market's not always trending, and what happens is, they get this breakout, then supply comes into the market and the breakout fails, right? You only hear about the times it doesn't, when it's a legitimate trend and it haven't reached an unfair high, but it happens more than people realize. So eventually the buyers dry up and the move starts ticking, and the move down starts picking up. That's a bad way to put it. Even eventually the buyers dry up and the move down starts picking up steam, starts gaining momentum. I should change that, because you see move up and then pick up steam, but gains momentum on the downside. Momentum to the downside. And this is where you want to get short. Okay, so for example, a strong uptrend. Why you want to fight it? Why you want to fight a strong uptrend? Okay, I'll be honest, in here it looked like possibly this trend could be ending. And then it just goes sideways with the small deltas, 285. And then it picks up very strongly again here and keeps going up and up and up. Okay, this is, for your accumulation and distribution people, accumulation mode right in here before it keeps going up. Now, would I call this absorption? No, because the volumes are quite light still. 3,000, 6,000, 6,000. In here, to me, this is more signs of absorption occurring in here than in here. This is, to me, is accumulation. Why would I consider this absorption? Volumes are bigger. The net volumes are bigger. 22,000, 15,000, 16,000, 18,000, and then 16,000. I can see what's trading on the bid. I can see what's trading on the offer. I know that these are relatively strong volumes. Again, I don't really have any strong bearish signal coming in here to get short, right? This bar here, look, possibly could be, a good sell signal. Very strong negative delta, 1400, but the volume is kind of, light relative to what it was earlier, 16,000. Now, if this was, the volume was minus 17,000, I'd start to be a little bit more worried, rather than the market going sideways for right now before continuing on. So notice here, right? I put the question, when did it break, right? You're rallying up, strong deltas, 94, 423, 1300. Look at this volume, 5,000, 10,000, 14,000. You're averaging about 5,000 to 8,000 before. Here's 6,000, 5,000, 8,000, 5,000 again. 10, 14. Then it just starts pausing in here. Now I know by looking at the order flow, I got a nice point of control on the extreme up here, which is a very bearish sign. Everyone talks about these, the iron cross sell signal or something. When I see this, The only thing that would have made this like kiss of death for this market is if this occurred on the high. But you know what? It's one tick off the high. It's its own bar. And, you know, it's a red bar as well. I still got to respect that, even though it's not on the high of the day. You still got to pay attention to that. That's still a very important signal. So I know I got this volume here. I mean, what's happening? You got 800 traded on the offer, 400 traded on the bid. It was bid here. We went bid, trading bid offer. Well, it was trading bid, it wasn't trading the offer, but the market was bid here at 69, offered at 70. Just couldn't trade there because the sellers were in there hitting it. You know, previous bar, you got a selling imbalance. So even when it was bid offered here, people were hitting this bid, caused that imbalance. Went back in here, got up here, starts rallying, looks like we're going to come back up. People are still hitting that bid. That's why this one is so important. Then notice the volumes. It just goes, reverts back to normal, 5,000, 5,000, 5,000. Again, what am I looking for in here? Other signs. Well, this obviously, this point of control is a very bearish sign. Selling imbalance, selling imbalance, selling imbalances in here. You do have one buying imbalance, but this is actually a bearish buying imbalance. Why? Is because market starts ticking back up. You get this imbalance here, 85 against 477, goes bid, 194 against 3. People are selling that bid, and then it just drops off dramatically here. Comes down here, you get the green bar. Looks like it's coming back up. Hey, you got a stack buying imbalance. That's it. We're off to the races again. We're going to hit the highs. But lo and behold, boom, strong negative delta, back to strong volume, 8,000. Again, you know, what were you looking at here? Other than this bar at 9,000 and this bar, that big push up, you got 4,000, 4,000, 4,000, 5,000, 5,000. Big negative in here in the tenths of delta, minus 1,000, minus 1,000. Selling imbalances. Again, the trigger, understanding it, is this heavy volume up here at the top of this bar, right off the high. Even in the previous bar, 1145. So what are you looking at? You're looking at about 2,500 traded right here on the offer up here. Next level, also about 2,500. Next level, it's about 3,500, 4,500. So about close to 5,000 contracts traded here. Massive volume right up in here. It's understanding what's going on. People are selling it up here, right? And showing up here in the volume. You can see a lot in here, to a lesser extent here. So absorption is going to tell you when momentum is stopped. Like I said, right up in here. The market has been selling off, taking out lows. All the shorts are happily counting their money. You know, the market hits a level where they're passive buyers waiting for the market to come to that level, right? So what's happening when a market is selling off? Everyone's short. Hey, let's get short to join the party. Counting how much money they're calculating on their, you know, I look at my bottom line on my Ninja Trader or whatever and see how it is. But then all of a sudden it hits that level where there's big passive bids in there. People sitting on the bid, just waiting for them, you know, trapping them, you know, like I call it a sleeper cell. The buyers awaken and start buying more, not wanting to miss the buying opportunity at the low prices. The aggressive buyers start coming in and buying imbalances start appearing. Delta's getting stronger, but after a few bars, prices isn't really going higher. Delta's contracting and no imbalances for a while. What's happening? Momentum has stopped. Now maybe absorption. So what that means is markets come down in here, starts rallying up, then possibly you're running into some absorption in here again and continue back up. Excuse me. So you're coming down, buyers waiting in here. Look at this volume, 200, 130, 138, 181. You get down here at 173. Aggressive buyers start stepping in, buying imbalances, buying imbalances, buying imbalances. Very bullish sign in the point of control right here. Even here, these 5 bars is very, very bullish. More buying imbalances. You get the big volume push. Okay, can't go any higher. You get the inside bar, which is a sign of possibly market going sideways. Starts going sideways. But at that point, what I'm doing is you know, is there a sign to get out yet? Not really. Still got some positive deltas. Volume is, you know, this bar is nice, 2,000. This bar also nice, 2,000. So there is some support in here. You know, it's trading. Oh, this bar is the 2,000. This one's 1198. Come down here, 126. Point of controls side by side. Again, that's also supportive or resistant in the market, depending on where you're trading. Start trading a little bit higher, it's going to be your support. But look at this. Selling imbalance, selling imbalance, selling imbalance, selling imbalance. Now, I've talked about this in the imbalance course. When you see selling imbalances in green bars, do you think that's bullish or bearish, right? Selling imbalances should be in red bars, not green bars. And what that's telling you is you have supportive buying in the bar, supportive buying, supportive buying, supportive buying. I prefer them to be, lower than right up here at the top, but this one is still nice. This 133, the 15, it's kind of small volume. This 84 is very telling. But down in here, 74 against 18 towards the bottom of the bar, that's also very bullish. You've seen a lot of bullish signs in here of supportive buying. That's what you need on a trend, right? You need supportive buying, some signs of supportive buying. It's nice if you could get all the signs appearing at once, but sometimes, you got it here with the point of controls, supportive buying. It's very bullish when you have the point of controls in green bars lower than the previous green bar. It tells you the market tried to push lower, but there was supportive buying in there. Just as you have it here, green bar, market comes in, starts trading lower, but you have supportive buying. Market goes up, supportive buying in here. Supportive buying here, supportive buying in here, and the market continues up. That's what you need in a trend, and that's a sign of absorption. Buyers are absorbing the selling going in here. It's like a fish swimming upstream. It's like you're trying to go against the current. Don't go against that current. Don't think, oh my gosh, I got the 74, I got a selling imbalance, I got to get short. No. If it's a green bar and you got that selling imbalance in there, be very wary. Don't think the market's going lower. If it's a red bar with selling imbalances, yeah, that's what you expect to see. But if you start seeing green bars with selling imbalances, you got to question it and take it in context with what's happening in the markets. So here's what is this? Gold. Okay, most of my charts have been E-minis and crude oil, but I'll show you other markets. This is gold, and what do you have here, right? New highs. Like, remember what I was saying earlier, right? Long-term traders are going to be selling at new highs, right? As you're going higher, that's their opportunity to get out. Because if they start selling in here, notice how many bars it took to get up to this high up here, right? Well, not counting this one, 1, 2, 3, 4, 5, 6, 7, 8 to get down to this 13, 19 level. So it took 8 bars to get up there, but 1, 2, 3, 4 bars to get back down there. So it got back down in half the speed. Why? Because once people start selling, it's got more of a snowball effect. I think the downside moves faster than the upside. And notice all these selling imbalances, 1, 2, 3, 4, 1, 2, 3. That's very bearish. Double bars with basically multiple imbalances in it. And even on this move up, you're seeing these selling imbalances in the green bars. You have your very bullish signal. You would think that that's bearish, right? Oh, I got 131 against 125. That should be bearish. Why is the market going up? It's because people are supporting that market. 125, 135. Even up here, you see the 118, 100. As it's going up. But here, even as you're going up, look at these volumes on the upside, right? 400, 300, 297, 400, 300. As you're making out new highs up here, 400, 300, 200, 200. Even up here, 200, 133, 117. Going higher on relatively stronger volume, 4,000, 2,000, 2,000, 3,000, 2,500, 2,500. Relatively, to earlier, you're looking at, 900 to 2,000 area in between these bars, total volume. And then boom, you get the big slam down, 2,500. A little bit lesser volume here, a little stronger volume on this move down. But the sign was up in here. You could possibly be getting short. Market did rally back up, but why? It came back in here. You met some passive buying, 347, 180, 113, 199, 415, 190. So you got this supportive buying on the move back up. Look at this. This type of bar, I could do a course on sort of bar shapes You know, it's not something that many people really talk about, but this is the type of bar that's very bullish. You know, notice you got two price levels, each, 52, 13, 41, 67, 66. It's in the double digits. Here it's in the triple digits, 138, 192. That's a very bullish shape. You know, like if you were to do shapes as if, like women's body shapes, like down here, 150, 119, 114. The bottom price level generally is going to be very limited volume, just because it's, based on where it is. It's at the low. But up here, 23, then 11. But, if I'll do a video on that. People will say it's ridiculous, but you know what? Sometimes the simple things is what's most profitable. So again, it might be a little bit easier to see on the delta chart. This is the delta chart. It's the same chart here. This is just the delta one. This is the volume footprint. This is the delta. So as you can see, 119, 72, 25, 40. You're seeing some big pockets of volume in here. Just as you're going up here, right? The offers. Look at that. It's mostly trading on the offers. Mostly trading on the offers. Mostly trading on the offers. But when it turns, it starts turning in here. All bids, except for that one on the high. Mostly all bids except for one. That's where you're getting short in this bar here. To catch, it's a big move. It's $2, but hey, $2 in the gold is not that bad a trade actually. So what's happening at the high is aggressive buyers are coming into the market and lifting the offers, right, as the market's going up. So as the market's rallying, prices going higher, sellers are attracted to the higher prices and start offering their supply on the offer side on the way up. When the aggressive buyers are buying those offers from the passive sellers, that's reflected in the strong positive delta. So again, going back to the chart, aggressive buyers, right? You see positive delta. That's why, that's why it's important to keep your eye on the delta, okay? Because not always at the highs are you going to have positive delta. It's when you start seeing signs of negative delta, it can tell you two things. One, you could have negative delta as you're making new highs. Say there's a big buyer in here. Say someone's bidding, what is this, 13, 20 even for 5,000. Everyone's selling into that. You're going to have a negative delta. You got to look at the charts and understand what's going on. But generally, as you're making new highs, you should have the positive delta. And what they're doing, the aggressive buyers are buying from the offers, right? They're buying. That's how you get the positive delta. But like I said earlier, right, the long-term traders will be selling on the moves up. It's not necessarily the short-term traders. Short-term traders are momentum traders. They're going with the direction of the trade. Finally, the buyers are exhausted because of the excess supply. That's what stops the moves, right? When people talk about price exhaustion, the buyers can't buy anymore, right? They're loaded up to the gills now. They kept buying, and then now they got to stop. They don't have any more margin in their accounts to keep buying. They're already long, and the market's in their favor. They're thinking, oh, happy days. And then that's when the big short-term traders come in and whack that market down. All the retail traders are getting long. The smarter money gets short, wipes them out, and then the market continues back in its regular direction. So again, finally the buyers are exhausted because of the excess supply. The sellers sense that the prices are too high, and it's a good selling opportunity. The sellers don't want to miss out. So while keeping their offers in the order book, they start hitting bids at or around the highs of the day. It's reflected in the negative delta and sometimes small positive deltas. So they're hitting those bids in here. It doesn't necessarily mean that they're moving their offer down, offering it down, offering it down, offering it down. They're just hitting the bids, hitting the bids, hitting the bids. And then the market snaps back. Okay, so here, what's going on? Big up bar, 12,000. It just stands out. Everything else is, if this was 2,216, it'd be about average, right? But most of these bars, 3,000. Everyone is getting excited. Everyone's coming in. What's happened? Trading that heavy volume up here near the high. The aggressive sellers start coming in, hitting these bids. They're still working the offers in here. 278, 190. Even in here, as the market's going lower, You know, they're hitting the bids, but they're still keeping their offers in here. You know, 180, 217, 720, even in here, 533, 537, 723. That's what keeps the market going down. Just as you get down in here, right? You're going sideways. Look at this, 719, this point of control, right up near the high, 562 against 27. Even when it was offered there, it was 719 traded. You got this volume going through, heavy volume right here. That's what's keeping this market from going back up again. Now, what happens when the market sells off is the sellers get triggered, right? Heavy selling volume comes into the market. Traders are tripping over themselves, hitting bids, and it's reflected in a strong negative delta, right? Overall volume of the bar is above average. Then the buyers appear at the low prices. Demand has finally come into the market. That's what's going to arrest a move lower is demand. And oftentimes you're going to see it with the volume on the bid side. That's why everyone talks about, you know, divergences, the order flow divergence, positive delta at a low. But what you also like to see is you like to see heavy volume as well traded on the bid side. Now that runs into a problem, right? Because with the divergence, really what that's measuring is the aggressive buying coming in. But if you have a green bar at a low and it's got negative delta or a small positive delta, pay attention to it. You know, people sometimes they see a divergence at the low and like, you know, like in the S&Ps, and they'll say, well, you know, the delta is quite small. It's only like positive 60 when, you know, all the other deltas are in the hundreds, like 400, 500, 1,000. They say, well, it's got a small positive delta. That's actually the type you should pounce on, right? Because what it's telling you is the sellers were in there pushing the market lower, hitting those bids, but they were being absorbed by the traders, right? By the bidders there. That's what's causing it. And, you know, imagine you have the low, and normally the bar's got a delta of 1,000, okay? But it's got a small positive delta of 20. You might think, well, it's 20, it's kind of neutral. But what's happening? You're at your low of the day, and you got this small delta. Bars traded 25,000 contracts, you got a delta of 20. Well, chances are, you know, the bid volume and the offer volume is, you know, 12,000, you know, 12,500 against 12,500. But more importantly, what you had was people there bidding that market, supporting that market. That's why you got the small positive delta. Let me see. Let me pause this for a second, see if I can find an example. I don't have one in here, but let me see if I can pull one up real quick. Okay, so this is what I mean. Okay, so this 5-minute E-mini chart. Look at this low of the day. Look at the delta, plus 125, right? It's almost, you know, your smallest delta in the, look at the volume, 12,000 is decent volume. Previous high volume on this chart, 18,000. Bar here, 12,000 as well. But look at these deltas. 125, okay, this is 1,000, 800, 263, you know, 113, but 900, 1,900, 1,300. You get down here, what's happened is why you have such a small delta. Well, you have a lot of negative delta in here. People are selling this 1,272, 1,279, 1,000. You know, on the way down here, you don't have that sort of volume. You got, you know, here you got 1,100, 1,600, but you got 700, 400, 900, 400. But the second time you came down here, the bidders were here. They're ready to support this market. That's why you got a small delta, is because you got a lot of negative delta down on this part of the bar, that by this upper part of the bar, it's a lot less in the sense that people are being aggressive now. So down here, they're very negative, right? Look at the min delta, minus 1,200. And the bar finishes at plus 125. So early on, very negative delta, but it was absorbed. All that selling was absorbed here, and the market starts ticking higher. People start lifting these offers, Bar finally finishes, not enough time to really turn it a strong positive, but still, it's a small positive delta. Why? It's because you had that big negative delta in here. So don't be thinking, oh, you know, it's only 125. It's so small. It's kind of neutral. I don't want to pay attention to that. Actually, that's the one that you should pay attention to. So getting back to some of this selling pressure, right? So Here's the chart. Sellers tripping over themselves. People can't get enough of this. They're selling it, selling it, selling it. Look at this here. They're all excited. Market's selling off. Hey, let's sell. Yeah, minus 1900, or sorry, minus 1600. Volume is 7,000. Then it goes sideways. People get excited again. Oh, we're coming off. We just took out this swing low here. Boom, look at this heavy volume. 500, 300. Each of these levels is 500 to 800. Bars got 10,000 volume. Big strong negative delta. Minus 1600. Everyone is, I gotta sell. We're breaking out. We broke out by 2 ticks and the market snapped back and rallied. Positive deltas coming in here. The aggressive buying coming in. You can see it in there. Now, maybe it's a little bit more obvious on the delta footprint chart of sellers tripping over themselves here. Look at that. All sellers. This is, to me, this is what retail sales look like. Right? Not the indicator, but retail selling rather. Let me rephrase that. Coming in here. Then you get these small inside bars. Look at this bar. It's got 5,000 contracts traded, which is half of what the previous bar was. Delta again is small. It's plus 111. But it's not small because it didn't trade much volume. Here you got this bar, 2,500 contracts traded. It's got a bigger delta, 165. Here you got twice as much with a smaller delta. So what it's telling me is early in this bar, you had smallish delta, negative delta. You had minus 136. But there was some absorption going on in here, right? You got that inside bar. Again, watch for those inside bars after the big push down or the big push up. But again, if you're looking at the delta footprint chart, right, you see all selling, right? These are kind of mixed bars here. You got selling on both sides, buying and selling both sides. Then in here, I mean, look at this pockets in here, 144, 104. You're seeing the supportive buying. That's what you like to see on the way up. So absorption, again, doesn't usually occur at one price level. People like to always talk about support and resistance. They think of it in one price level. Absorption is usually spread out over several price levels. But again, don't fall into it's got to be one price level. People always like to try and project prices to a particular level. You have to project it to a particular area. I always find it fascinating how people use these Gartley patterns and things like that, bat wings, and they'll say, oh, it's predicted it to the tick. Well, so what? If it got 1 tick away, it's a complete failure. Say the market moved 300 ticks, and then, the target was 300 ticks, so it got 298 ticks there, then reversed. Does that mean it's a failure? No, you got to think of it in levels, areas, rather, than one particular level. Now, one of the easy ways to determining absorption is happening is, of course, watch the delta. The delta will increase either positively or negatively, but price won't move with it, right? That's what I was just explaining earlier. So you're coming down in here, heavy volumes in here, you're at your low, you got 5,000. This low is 11,000. So you got some decent numbers in here, 7,000, 8,000, 6,000, 7,000. Where's the market going? It's going nowhere. It's going sideways, right? That's when you got to start paying attention to the next level of stuff. Deltas. Look at the deltas. Getting stronger here. Getting stronger in here. You do have, you got a strong negative delta. You got a strong negative delta. Yeah. One bar. What you got? If you can string together 2 or 3 bars of strong positive delta that's growing, I think that overrides, a bar of negative delta. Imbalances. What are you seeing? You're seeing the buying imbalances more so than the selling imbalances. Well, people say, well, you got 2 selling imbalances in here. Yeah, okay, fair enough, but we couldn't go any lower. And then I start seeing delta pick up again. I'm not saying I'd be buying down here at this low. I'd probably be buying somewhere in here, coming off this low. That's a legitimate buy. Where's your stop going to be? It's going to be down in here, at the low, or maybe a ticker, maybe a little bit above it. We got this open space in here to play around with. You got these point of controls, higher. It's starting to look more bullish than bearish. But again, what's going on in here? You got decent volumes, but the market's going sideways. 8,000, 6,000, 6,000, 7,000. It's just sort of going sideways, but starting to creep a little bit higher, right? That's what you want to be looking for. The sign in this case is in the delta. Okay. Here, right? We're making new highs. This is wheat, okay? I figure I got to throw in a couple other markets. I got a prominent point of control up here at the high. You got a ratio and divergence. But here, right, you got divergence failed, divergence failed. Is this one going to work? I don't know. But when I start adding what's going on in the market, I start seeing, okay, well, I got a prominent point of control on a wide bar. You know, here you got a prominent point of control. This one I got to overlook because it's only 3 price levels. Same with this one. This one's a long bar, right? But look at this volume, 669, 115. So imagine what's going on, right? You got people offering supply up in here. They didn't have it at this level. You know, in grains, it trades in quarters. But look at this. You know, you got 133, 332, 206, 182, 218. Here, 269. Even when it's bid here, right? 569. So you got sellers coming in and hitting those bids. Now you're up in here, right? You're at your high, 1399, 1658, right? You got positive delta on a big down candle. You should be scratching your head saying, what's going on? Why do I got positive delta? It's quite decent on a big red candle down. Then you start looking at it, right? Oh, I got this buying imbalance, 316 against 37. Someone's offering supply in here. Here, imbalance, imbalance, imbalance here. So I know at this level, you know, if you do the math, that's, you know, over 1,000 contracts trading at that level on the offer side, mostly. You know, that's a bearish sign. You know, even in here, you know, you still got this red bar, right, with positive delta. Okay, you know, people say, well, you got positive delta, that should be bullish. Well, it's actually, in this case, it's more of a bearish sign, right? You got the buying imbalances. Why isn't this market going higher? Is because you got someone offering the supply in there. Sort of runs contrary to normal thinking, right? You're thinking, oh, I got buying imbalances, I got positive delta, but the market's not going higher. That's the whole point of absorption, right? You got to be asking yourself, what's going on, right? If sometimes what doesn't happen versus what is expected to happen is more important when it doesn't happen, right? You're expecting this market to go up. Positive delta is increasing. You got decent volumes in here. Positive delta, imbalances. What's going on? Why isn't the market going higher? It's because you have someone offering it. They're absorbing all that buying. You know, everyone is looking at this. Everyone's thinking this market should be going up. Let's buy it. Let's buy it. But there's a big seller in there absorbing everything. And finally, the market fails. You know, this is one of those trades where, you know, you get short, you just have a stop, you know, a penny away. You know, not I'm gonna say one tick, but you know, you gotta give it a little bit of room. You may get past it, you know, right in here, like you do here. Here you get past it by 2 ticks, but still, you know, this is a trade. You know, if you're getting short here at what is that, 471 and a quarter, yeah, you gotta stop up here, 472 and a half, so about a penny and a quarter. But what's your risk ratio? You know, you're getting short at 471, all the way down, down, you know, into the mid 460s. You know, that's the type of trades that give you low risk opportunities. You know you got a seller in here that you can't get past. You've been trying to get past for 5, 10, 15, 20, 25, 30 minutes, and you can't get past it. You want to fight it? You want to buy it? Try and buy it? Or you want to sell it? You should be selling it. So when looking at absorption, you have to look at it occurring over a period of time. I think it's difficult to see absorption occurring on a very short time frame, sometimes like 1 minute charts. I think you can. I know I look at 1 minute charts or 3 range charts. I think it's a little difficult. But, you know, if you're looking at a 1 minute chart, it has to be a market that's got decent volume. If you're trading, say, nat gas on a 1 minute chart, you definitely going to have to look at it over a period of time rather than one bar. I think with very liquid markets like crude oil, E-minis, you know, on a 5 minute chart, you could take it on as easily 1 bar, but even on a 1 minute chart in a very liquid market, you could string together 1 or 2 bars and get a decent look at, if is there absorption going on. But a 3-range chart, I think, is kind of difficult. 4-range, pushing it again. It's got to be a market that trades decent volume. On short time frames, you can see transactional moves by funds, whereas on longer time frames, you can see the strategic decisions. So again, it doesn't mean that you can't see absorption on short-term charts like a 1-minute chart or a 4-range chart, but you got to put them in context. You got to use more bars than just one. So again, 1 or 2 big orders during a 60-second period can skew the data that you're trying to analyze. So just keep that in mind, right? This is wheat on a 5-minute chart. On a 1-minute chart, it's not going to look. I say not going to look. It's not going to give you much to go on in terms of market direction. Because honestly, on a 1-minute chart, a lot of the bars are going to look like this in here. So keep that in mind. So this concludes Module 3. In Module 4, I'll discuss accumulation and distribution and how it relates to absorption. So I'll see you on the next module. Bye-bye.